Hello, thank you guys for coming, especially because it's Prime Day, and you could be getting a free Slurpee or buying things on Amazon, but I appreciate that you're here. I appreciate the things that John Lothian does, because a lot of these conferences I go to, I got into this business 30 years ago, right out of college. A lot of what we talk about is kind of the new blood, and it's a challenge, especially because the market's really evolving. Things are becoming much more technological. I've been trading options and been in the business for, like I said, 30 years. About 20 of that was trading options from the exchange floor when there was one, and it kind of looked like that on the left, to electronic trading and working for a couple of banks. So I'm going to kind of show you what we do. I'll try to keep it interesting and not too into the weeds. But options are a very important part of the U.S. equity market. They exist on commodities and everything else too. And I'm going to kind of show you how we do things. The first question in terms of why anybody cares about options order flow is to ask why, okay? And basically, why is there information in the options markets that is valuable? Okay, there's basically 4 primary reasons people use options, and they tend to attract the smartest, most well-capitalized, most well-informed traders out there. Basically, dumb people lose their money trading options so quickly that they're not really out there anymore. I'm going to use examples for things and try to keep it nice and simple. This is a trade from yesterday. Leverage is the first and kind of primary reason people like options. In this case, if you had $200,000 to trade with, which is what this trade involved, somebody bought some calls in Malin-Kudrocht, whatever that is. The best traders I know think of stocks as letters. They don't really give a shit what the companies do. Somebody bought a couple thousand calls around the middle of the day, and by the end of the day, the stock was up $1.36, okay? The leverage in that trade basically turned their $200,000 into about $350,000 by the end of the day, even though the stock was up 3%, okay? That's pretty much it, okay? Even if you levered up, on a margin account 2 to 1, or as a hedge fund usually for stock, you can get 6 to 1. You're not going to get the option investment outperformed the stock by 20 times. Okay, this is one of the reasons that if you're a hedge fund and you believe strongly something's going to happen, you're certainly going to put your money where the leverage is. You're going to make a lot more money doing it. The second reason is about risk, okay? Defined risk. We could spend an hour talking about risk and derivatives, or maybe a month. The basic idea with an option is you buy it for some amount of money, it can go to 0, okay? It can go to possibly infinity, depending on what you're buying, but it is a relatively defined risk situation. There's a star next to it because if you think about it the other way, if you can buy an option and only lose all your money, in your worst case, if you sell the option, you kind of have the flip side of that. So options can be traded irresponsibly, I guess, or in a way to add a lot of risk. But that kind of defined risk, and it gets more advanced when you get into things, is a big feature. And number 3 is the flexibility. And this is something that has evolved a great deal over the last 5 or 6 years, actually. You now are into these daily and weekly expiration cycles. It used to be every 3rd Friday. Now you have, in Tesla, you have about 10 expirations. In Spiders, you have about 25, I believe. You can basically pick your time horizon when you're trading an option, and you can pick your strike, okay? And then you can start combining things to go crazy. But if you believe, I think Tesla has earnings around the end of July. You can put on a trade that's very specifically going to handle that event, that earnings event. You don't need to trade a 6-month option. You can trade it. You can almost kind of target it down to the day now. And then same thing in the strike department. In the longer dated options, because they've been around for a while, in Tesla you can trade strikes as low as 50 and as high as almost 700. What's interesting is there's actually a lot of open interest, which is inventory, in that 50 strike, even though it's a $300 stock. And then liquidity is the fourth kind of factor that draws people to trade options. You have $4.5 billion a day trading in the U.S. equity and index and ETF options markets. This is a handful of the bigger trades from yesterday. The liquidity that's out there in the options, in a lot of cases, exceeds what's out there in the underlying stock. Okay, you have over 1.1 million trades on average. 16 million contracts are trading. On a busy day, we do double that. It's very easy to get trades done. Okay, so if you're an investor, if you're a hedge fund and you have money to put to work, in a lot of cases, they go straight to the options market because the stock market, the underlying market itself, can be kind of frustrating. Who does this pull into the market? This is a cloud of the hedge funds that disclosed big option positions as of the last quarter. I tried to take out some of the liquidity providers because the market makers tend to overshadow everything else. It's going to be every big hedge fund you've heard of, right? Most of the banks, Soroban is a big ex-Goldman Sachs run trading firm. This is who is coming into this market, and this is why we're paying attention to what's going on, because these are not dummies. They're not out there to lose money. So now that we know kind of why we care, we can take a quick look at just trying to understand a trade. Okay, we're looking for as much clarity as possible, right? And in a lot of cases, it's a guessing game or the best guess you can possibly make. We're looking for significance. We're looking for the directionality, the timing, the urgency, the way a trade takes place, the impact, and then the accuracy and the personality of of trading behavior, which is a little bit more subjective, but it matters a lot. And that's where there's still a lot of the kind of creativity, a lot of the, I guess, the sense, that a trader, the talent that a trader would be bringing to it. We're going to look at an example. This is a trade in Weyerhaeuser from yesterday. And this is a buyer of calls, right? People buy calls when they think a stock is going to go up. Okay, like I said, there's 1.1 million trades a day. So every single trade you can look at has some information in it. The question is trying to figure out what does it mean and does it really matter? In this case, you can see they paid 55 cents. Okay, we use a bunch of rules. The market was 50-55, so if somebody wants to buy it, they usually have to pay 55 cents. And what's kind of wild is the way that this market works nowadays is this trade happened in 41 little pieces that touched every one of the 15 exchanges out there. And the whole thing took 12 milliseconds. Okay? This is why my company exists, because when I was working at the bank, the last bank I was B of A, and the customers would ask, what's going on? And you used to be able to pick up the phone and call a guy in the IBM pit at the SIBO and say, hey, what's going on today? And he'd say, oh, Goldman was in here. They bought a straddle. They bought some puts, blah, blah, blah. When trades are broken up across 15 exchanges and happening in 12 milliseconds, there's nobody to call. Okay, you need a tool that is built to help you figure that out. So in this case, this is the way the trade took place. Okay, I'll show you on the next screen kind of in terms of the significance, but it looks like a decent-sized trade, and we can see the way it happened was a very rapid-fire kind of shotgun, faster than a blink of the eye. And then this is the way that we tend to slice and dice things. So there's a few other pieces to it, but this is the meat of it, and hopefully it'll be somewhat understandable. Okay, the trade's at the top, so we don't forget what we're talking about. The first box on the left is just showing you where the activity is. Okay, that trade basically made up the bulk of the activity for that stock for the day or for the time that I snapped this. So this is kind of the one thing that took place that matters. In terms of, we'll go left to right and read it like a book. In terms of volume, okay, significance based on the size of that trade. This is all, basic math that we're applying to the real-time data and some aggregated data. On average, this stock sees 1,193 calls trading per day. So the fact that somebody bought 4,000 of them is 4 times the normal total daily volume, and it happened in a 12 millisecond blip. Okay, so it matters. If you think about this in terms of if you're going to put your money to work, or you can think about this in terms of if you're talking to a customer and you're supposed to be the expert. Okay, the truth is, I know a lot of people make more money being the expert than a lot of people make, than other people make trying to bet their own money. In this case, you say, okay, wow, that call volume is 4 times normal. It all happened in one blip. And you can actually see that the stock volume is 14% above normal. So there's not that much going on in the actual stock itself, but the options matter. The next one, the sentiment box. We have a pretty simple heuristic in terms of call buyers are bullish and put buyers are bearish. And at the basic level, that kind of works. In this case, it's green. 79% of the volume was a call buyer. Therefore, it looks like the majority of it is bullish. Another piece of data that kind of matters is this net option delta. Okay, if you did take any option or derivative classes, you'll know every trade has a delta, basically how much it's going to move as the stock moves $1. In this case, we're summing it up and saying, okay, because of that trade and everything else is traded, but in general, that's all traded, you have 200,000 shares to buy. Okay, this is a stock that trades 3 million shares a day, so it's a decent little, it's a few percent of the average daily volume. It's not insignificant. The next box over is total open interest. As I mentioned, that's inventory. The Options Clearing Corporation clears everything and disseminates data every morning showing how much inventory is out there. Okay, you don't know who has what. In general, you don't always know what was bought or what was sold, but you know how much is out there, meaning as of the time of this trade, there were 7,000 of these calls in existence, okay? And that's an important piece of kind of this puzzle that we help people put together, which is, well, 4,000 were just bought. We're pretty sure of that. There were already 7,000 out. So maybe this is just somebody that was short them, covering them for closing their position, whether they made money or whether they lost money. But I'll come back to that in a second. But it's an important data point for every single trade. The last thing we kind of look at is there some sort of catalyst? Okay, this one has earnings on the 28th, and these expire on July 21st, so it's not it doesn't get them earnings. And the very last piece of it is not market data, but it's important information that we collect, which is information from the trading floors that still exist, where this one is showing you in February that there was already a buyer of these, okay? So now you actually do know, well, there are 7,000 of them, and they were coming, most of them were coming from February where somebody bought 5,000. So this is actually somebody buying more, okay? And there's one way to confirm that, which is the following day when the open interest numbers are released, and you can say, oh, gee, it did go up by 4,000, okay? All of this together basically is the best possible picture that anybody's going to put together in terms of what's happening, and it'll help people make decisions. We've got a little bit more to put it in context. There's a time series of the call and put volume, just going back a couple months. So you can actually see that last line on the right is today, or was yesterday. So it's the busiest call day in a couple months. Again, it's significant in kind of the overall frame of things. And then some percentile data, which just helps you quickly say, okay, you know what? It looks busy. It looks bullish. Is there anything else about this that I can understand? And keep in mind, this is all happening in, you got about 10 seconds from when that trade hits to be the first person to know about it, or at least the smartest person to call a customer about it. So, at the bottom section, just really quickly, you can say, okay, yeah, you know what? It's green. The greens are top 20th percentile. So the volume's in the top 12th percentile, one of the busiest days of the year kind of thing. Call volume, we already know it's the busiest day in the last couple months. Well, it's in the top 7th percentile for volume. The bottom numbers are valuation related. I'm not gonna get into that because I'll leave it for you to study on your own. But it helps with motivation, okay? And basically, this is kind of helping you see that the options are relatively cheap in a certain way of looking at it. And then from there, basically, you quickly can either come up with a trade if you're a broker or if you're a trader. You can talk to a client and look like you're very smart because this stuff is pretty hard to assemble and to understand. You can integrate it into other trading styles, right? So if you're a value trader or you're a long, short equity trader, you now know that there's some reason somebody just put a couple $100 grand in a highly levered position into Weyerhaeuser. And you can basically use that to lean long. You can use that to just avoid getting into a short for a little while to kind of figure out if there's something going on. And then as a starting point for further analysis, maybe you're going to do long this stock against short Halliburton or something else. This becomes a good way to very confidently know there's some smart money going into this stock. This is the kind of stuff that you hear about on CNBC. And it's just kind of, it's the most mathematical and scientific / methodical approach to making sense of it. And that is it. Thank you.